I don't think it's helpful to have that, that kind of discussion for that period of time in the run up to the budget. It's not good for business.
Yeah. It's front loaded with announcements and then back loaded with the actual rises. Do you think there's a strategy to this?
As a country, we have one of the highest minimum wages, which is obviously fantastic, but we have one of the lowest growth rates out of the G7, which suggests that the two things are pulling in opposite directions. And how do we fund?
There was a fundamental flaw that you couldn't transfer your £1 million threshold between spouses.
Yeah.
Fortunately, they've decided actually now you can, which is good. But I don't know. What about clients who've rewritten their wills with, to taking this £1 million not being transferable? They're going to have to rewrite them again.
I think, you've got some business owners that are, making some quite drastic decisions, some big decisions off the back of that change that they probably weren't doing before.
I wonder if a lot of people left the country ahead of the budget, maybe before they were ready, to avoid a potential exit tax. Hello there, welcome to SRLV's Not Just a Number. This episode is slightly different. This is breaking down the Chancellor's budget. So I'm absolutely delighted to have two of my excellent colleagues here. I've got Steve Wren and Janice Lloyd.
Morning.
Welcome.
Morning.
How are you doing?
Good, thanks. Yeah, interesting times in the world of tax.
Yeah, it was quite a big budget off the back of a big budget last year in 2024. So I guess the first thing we're probably supposed to talk about is the accidental publishing of the budget by the OBR?
Yeah, I mean, it was...
You were watching it, weren't you?
It was amazing stuff, really. I mean, I've been involved in tax for 36 years, and it's just sacrosanct. You never understand what the real budget detail is until after the Chancellor sits down. So it was amazing that an hour before the budget, basically all of the budget... was
BBC knew more than anyone on the backbenchers.
It was outrageous. I mean, I remember, back in the day, standing in the rain outside Somerset House waiting for these bits of paper. You never got that kind of thing. So to get all of that information out in the public domain, before the Chancellor's even stood up is
so
just outrageous.
Were you looking through the documents?
Well, I think everyone
was it distracting from, you're supposed to be watching what Rachel's saying?
Well, I think it was it was just a live conversation, wasn't it? So you had people reporting on the budget speech while also looking at the report and going, well, so this is coming and that's coming, and she hasn't got to that yet. So it was interesting stuff.
Well, shall we maybe set the scene? So last year's budget, absolutely massive one. That was Labour's first budget since winning the election. I think, what was it? They raised 38 billion. Was that right from the last budget?
Yeah.
Capital gains tax rates were increased. That was up to 24%. SDLT, you've got the 5% surcharge. The non-dom regime, that was the big one that I'm really interested in. The non-dom regime, the remittance basis completely abolished, and we've got a new long-term residence and foreign income and gains regime. What else did we have?
I think we also had the big impacts in relation to inheritance tax, particularly around tax on pensions and
that was the big one. Inheritance tax on pensions and the 100% business and agricultural relief limited to 1 million, and then it's 50% after that.
Yeah, I mean, again, it's just a lot of these things that are due to come in future years that haven't yet come in. So it seems to be very much the way budgets are going these days. It seems to be, it always used to be a budget would be announced and the change in the rules would come in a few months later, maybe on the day, but sometimes a few months later the next tax year. Now they're announcing budget changes that could happen in a few years' time.
We were talking about that, weren't we, Janice? That it's front loaded with announcements and then back loaded with the actual rises. Do you think there's a strategy to this?
It's interesting. Certainly the 25 budget has had a lot of measures that will not come in, and some even beyond the election date, which makes you wonder if that's a strategy for it to be something for them to use in the election manifesto next time round.
Yeah, why don't you just cancel one of these raises you've already announced, and then that's as good as a tax cut.
Yeah, and to bring the electorate back on board, or Yeah, and the other thing I think is people are not going to feel what it means to them for a couple of years.
Yeah.
And we've got more budgets to come. So, is this the layering of tax on us?
Yeah, quite possibly. So the budget, it was last week, a month later than usual. Normally it's around Halloween. And it's normally quite a scary time. But, we had it in late November. Do you think that helped or hindered things? A lot of rumours, weren't there?
I think it gave them a lot of time to float ideas and gain public reaction, all of which I think is unhelpful. I think it creates a lot of uncertainty, and clients don't know what actions to take and are seeking advice that we're not able to give. I think the uncertainty has manifested itself in the slowing down of the economy and the grinding to a halt of the property sector. So the leaking or the floating of ideas, I don't think is helpful.
I think it was, it seemed to be a lot of, let's kind of put an idea out there, see how it sits, and then we'll kind of decide where we go from there, which seems a bit crazy. I mean, particularly, the OBR having its wings clipped already in relation to only doing one forecast a year rather than the normal two, I think was put out there to try and keep the business community happy. I think it made it much easier after they decided to leak the budget report to clip them. But I think there was a lot of that, a lot more this time around than before. Maybe there was just because everyone was expecting it to be a bad budget, but I don't think it's helpful to have that that kind of discussion for that period of time in the run up to the budget. It's not good for business.
Yeah, and I think this is what are people saying? It's expected to raise 26 billion by the end of the Parliament. This on the back of a 38 billion last budget.
Yeah, I mean,
and it turned out the government had 21.7 billion fiscal headroom.
Yeah,
from their self-imposed rules. So
I mean, if you look at it over recent governments, I think 21 billion is fairly low, but it was still a decent chunk of money.
It was more than expected.
Yeah, I mean, I think
it's double. I think.
I mean, I think I read some report that that this government's due to be collecting. I think it's something like 120 billion a year more in taxes than previous governments. So, I mean, the numbers are eye-watering.
Wow. Okay, I guess it's probably we're going to talk about what was announced very shortly, but it's probably just as interesting to talk about what wasn't announced. So a lot of things were rumoured or perhaps leaked or floated. So what's the one we were talking about, Steve? Inheritance tax and changing the potential exempt transfer gifting, lifetime gifting rules. Yeah,
I mean, we've certainly come across a lot of changes in clients' attitudes as regards gifting. Some making some substantial gifts that they weren't perhaps considering before. So, a lot of change or a lot of discussion or rumour again around people making gifts because they think the 7-year rule in relation to gifting is going to disappear. So, you gift a sum of money and it takes effectively 7 years to fall outside your estate.
But that type of rumour is it's affecting people's decision making. They're saying, well, I'm going to make a gift now because I think it's going to be subject to a 10-year rule after the budget.
It worries people, and people react to rumour. They don't wait for the rules and go from there because, again, they don't know when the rules are going to come in. Is it going to come in straight away? Is it going to be deferred? What's it going to be?
So, I suppose that we didn't see any inheritance tax or gift change rules generally. I know you've got some views on this, Janice. A general increase to income tax. It was kind of floated, wasn't it?
Definitely was floated.
It would have been definitely breaking a manifesto pledge.
It would have been. And I think along with the big black hole that was communicated, now albeit maybe incorrectly, something felt like you needed something quite substantial to fill this hole and take the country forward. So a rise in income tax, you can see why that was a suggestion. Should they have been bold and done it? Possibly. It does feel, I think you said it, Kieron, a bit like death by 1,000 knives.
1,000 cuts, isn't it?
rather than one fell swoop. But I think coupled back with the uncertainty, it just makes you wonder whether that's something that will come in the future.
Mm. Oh, I guess one that's possibly quite relevant to us. We are an LLP. There was a big rumour that they were going to put employer national insurance on profit shares for LLP members. Do you think about that? A sigh of relief for professional service firms and GP practices everywhere?
Yeah, I think so. I think, the headlines is it's kind of lawyers, but, there's lots of people that use LLPs. And so, it was certainly an interesting topic of conversation for a period of time. But again, it was kind of like there was nothing off the table when it came to the rumour mill, really.
Yeah.
And so, it kind of, you got to the stage where it was, we'll kind of discuss it, think about it, but it wasn't really more than that.
Yeah. I heard some rumours that stamp duty land tax, SDLT, was going to be completely abolished. That clearly never came to pass. I heard some rumours about stamp duty land tax on property-rich companies. So at the moment, if you buy a company that owns a residential property, for instance, there's no SDLT on that transaction. There were rumours they might have changed the rules there. I heard someone also saying private residence relief could be abolished.
Yeah, that
would be a big one.
I mean, that would have been seismic, but I think it was more in the context of, I think, of high value homes.
Yeah.
Which as we'll come on to, later in the podcast, the kind of the mansion tax seems to have been how they've approached it. But it was one of those things. Well, how do we collect a little bit more tax from people we think have got the broader shoulders to take it?
Yeah. One that I've been speaking to a lot of individuals and families about is exit taxes. Fortunately, we haven't got an exit tax for individuals, but it was spoken about a lot. And I wonder if a lot of people left the country ahead of the budget, maybe before they were ready, to avoid a potential exit tax.
Yeah, I
Bit
think
of a frightening one.
Yeah, it comes back down to people taking decisions.
Yeah,
because these things are rumoured, rather than actually planning.
Yeah.
And making sensible decisions.
I think from my perspective, I think it was probably more the changes in the non-dom regime that probably forced people, that's the wrong word, but made people make the decision to move.
Yes.
I think the exit tax, whilst it was talked about, I don't think it was a big driver. I think it was a change in the non-dom rules into the more residency-based system that really drove decision-making in that regard, and we saw quite a lot of that.
Yeah. What else? Well, I was also, some people were talking about rules to attract entrepreneurs, international and domestic, but we never really saw any of that.
Yeah, there's a vague reference in the budget press releases, which is always where the
what was that? That was the devil's in the detail. Something about some sort of scheme to attract, what did they call it? High potential.
Yeah, it was a short
individuals.
It was a short paragraph that didn't really say very much, but it kind of gives you a little bit of hope that there was kind of maybe some sort of global visa kind of arrangement that they're thinking of. But again, it's out for consultation. It's going to be a couple of years away. So yeah, it was kind of a little crumb of comfort, but not really anything tangible.
It is quite weird, I suppose, in this country that we actually have quite a favourable tax regime for people coming into the UK now under the new FIG regime, foreign income and gains. But there's no visas for these people to come here legally, which is which is a massive issue. There needs to be an alignment between the visa and immigration system and the tax system. Is my strong view.
Yeah, well, I think, I think again, it's all headlines, isn't it? Headlines about we're going to get rid of the non-dom regime and replace it with the FIG regime, but then you haven't got the administration of it in place to actually make it work, which is crazy. But that needs to happen and happen quickly.
Well, I suppose that's what was not announced. So, but it's just as important because these rumours are driving people crazy and making people make perhaps the wrong decision.
But I mean, again, it's, such big changes been announced previously, and because they're staggered changes, they're changes coming in. We're quite glad actually that there wasn't any more changes in relation to a lot of those things, because there's lots of big changes coming down the road that people have kind of just got more comfortable with, because again, we're into that process of announcing a change that's going to come in a couple of years' time. So it captures headlines at the time, but then people forget about it because it's not coming in for a couple of years. It's strange the way the budgets are presented these days.
So shall we move on to what was announced? I guess the big old one that I guess we're going to get sick of talking about this because it seems the same every year. The big freeze. So the freezing of the thresholds. So what have we got? Personal allowance stuck at 12,570. Basic rate 50,270. Higher rate 125,140. Additional rate is above that, and then you got national insurance for employers stuck at $5,000.
Yeah, I mean they're obviously saying that the rates won't freeze now for, I think, 10 years, a decade. But they haven't really changed that much up until that point for quite a few years.
Yeah.
So really, this has been something that's been around for quite a long time. I mean, to be in, I think, 2029 or 2930, having one out of 4 workers paying higher rate tax when, I mean, I don't know what the numbers were before.
Well, I did a quick Google earlier. It was 3.5% of taxpayers in 1991 were higher rate taxpayers.
Yeah.
And now they'll go to 25% by the end of this parliament.
It's just unbelievable, isn't it?
Yeah. And I guess average earnings, they do keep going up. So this is, I think, expected to raise 8 billion. So it's the biggest measure in terms of tax take.
Yeah.
Yeah.
And I was listening to a podcast that was talking about pensions and how these state pensions increasing, and that will start bringing pensioners into the charge.
Well, they'll be over, if they've got no other income, they're going to be over the personal allowance.
Yeah.
Well, interestingly, I did see there was I think an article on BBC website, I think it was over the weekend, and I think there's been some commitment by the government to say if your only income is your state pension, you will not be required to pay any tax. So I don't know quite how that's going to work, but there is, so whether if you've got a pound's worth of bank interest means it's fair game, I don't know. But again, the devil will be in the detail. But, there is that commitment again. And those kind of commitments cost a lot of money, the pension triple lock and those kind of things. They're things that require a lot of tax revenue to support.
Yeah.
Yeah.
I suppose, what else did we have? Tax risers. So I don't know if this technically breaches the manifesto pledge, but we've got income tax increasing on dividends. So that's up 2%. But it's only for basic rate and higher rate taxpayers, not for additional rate.
Yeah, which is something I noticed quite quickly in relation to these 2% rises seemingly across the board on most things, but not for dividends. And I think the main reason for that I can think of is that at that particular level, you're dealing with kind of entrepreneurs, owner-managed business owners. And it's quite clear for them that a 2% on the additional rate, I think so, going from currently 39.35 up to 41.35, for instance, would mean that they would just take salaries rather than dividends.
Yeah, because you don't achieve much by changing it.
The effective rate is it's not worthwhile doing. So, I think, the Chancellor or the government was quite savvy, and they knew that would just change the way people approach it, and so they left that where it was.
What else we got? Savings 2%, so that's interest income, so that's all the rates, basic rate, higher rate and additional rate, and also property, so rental profits, so this is your landlords, up 2%, so that one's going to be effective from 2027, but landlords are getting hit quite hard. What do you think? Yeah,
I think they've had a focus, haven't they, on people earning income from rental properties.
Yeah.
They've been trying to deter people having second homes and trying to stimulate the housing market. So I don't think this comes as a surprise.
Yeah. Because we had the 5% SDLT increase, stamp duty land tax increase in the last budget for additional homes. So it's just a further attack on landlords. And I suppose they're just going to pass that on to the renters.
Well, yeah, you would expect so. I mean, there was, there's the restriction on mortgage interest relief.
Mm-hmm.
There's been quite a lot of different tax rules coming in to kind of try and cool the property market to some degree, but also to keep it moving. We've also got the rules coming in relation to tenants' rights coming in as well. So there's lots of different things coming in around the property market, and I think the government would like the housing market to cool slightly, but that's not just the Labour government. I mean, previous Conservative governments have done the same thing, perhaps not to the same degree.
I suppose it's quite easy to tax property because it's difficult to move. It's physically in a place, whereas financial assets are, you can shift them around. So I guess the government's got wise to, let's just tax something that is physically here.
Yeah, I mean, I think as you said, Janice, I think it's also it's there's a lot of aspects they don't like, but I think ultimately landlords will increase the rents that they charge, but then there's a limit. We'll come on to that in relation to other sectors of business. That there's a limit as to how much the customer is going to be willing to pay
and can afford to pay.
Yeah, and can afford to pay.
I suppose sticking on the subject of property, we've got are we calling it the mansion tax, or are we calling it the ever so catchy high value council tax surcharge? The mansion tax.
So we'll stick with mansion tax. I think that's a lot easier.
It's a weird one, isn't it? Because it's attached to the existing council tax system, but it's payable by the homeowner rather than the occupier. And we've got, it starts at $2,500 if your property's worth more than 2 million, and it rises to $7,500 if your property's worth more than 5 million. So, you're going to move house, Steve?
Luckily, that's not a problem for me. I think there's lots of detail that we're missing in relation to this. Yeah. How it's going to operate, what kind of relief there's going to be. There's going to be a big consultation again. I don't think it's coming in for a couple of years. So
yeah. And we talked to Janice. We spoke briefly about how are the cash poor but house rich people how are they going to deal with it?
Yeah, and the disparity, I think, across the country in terms of what 2 million
will buy
you doesn't necessarily mean these people are more affluent. So yeah, it's a hard one. I think it was a replacement of the wealth tax, and maybe a bit more reasoned than a wealth tax, but people who are asset rich and cash poor are going to struggle to find the money to pay the charge.
Yeah. So what's going to happen? Is it going to be taken out of their
well, I think there's a couple of options. Isn't there? I mean, again, it's a consultation, so we'll see what happens from them. But you can imagine that for those people, as you say, that are asset rich and cash poor, it's going to be we'll let the charge roll up until the property's sold or transferred. Or ultimately it just stays as a liability and actually is taken out of the estate on death. Sounds rather macabre, but that would seem to be the only
take
options.
It out of their cold dead hands.
Yeah, exactly. I mean, but it's that seems to be the only way you could do it, because I'm sure there's going to be many people, and it's quite right to say there's going to be many people where, yes, it's going to be inconvenient. They're not going to want to pay it, but they'll pay it nonetheless.
Yeah.
But there are going to be people, as I think, there's been commentary on that in the press, many people that simply don't have that kind of liquidity.
Yeah.
And it's going to be a struggle for them.
Yeah. And what will it do to the property market? Again, our people, it doesn't come in yet. So there's a timeline where people will maybe start to move and downsize.
Maybe people will downsize.
Or will it get to the stage where people have got so much charge rolled up in their property they won't move? So we're seeing, the property market stagnate again.
What about inheritance tax? Should we talk a little bit about inheritance tax? I think if you remember back to the last budget, the inheritance tax rules on business and agricultural property.
Yeah.
There was a fundamental flaw that you couldn't transfer your £1 million threshold between spouses.
Yeah.
Fortunately, they've decided actually now you can, which is good. But I just don't know. What about clients who've rewritten their wills with, to taking this £1 million not being transferable? They're going to have to rewrite them again.
Yeah,
it's just a shambles.
It is. It is. I suppose, from the government's perspective, they're saying, well, we're announcing it before the rules come into effect, so everything's okay. But like you say, people
plan based on what was announced. You should, I would have thought, be able to rely on the certainty of what the authorities say.
Yeah, definitely. I think, but getting back to the point, it's a very good thing.
Yeah. It is positive for our business and farm owning clients.
But I think it's still a massive impact in relation to people that have high value businesses that they wanted to pass on to their family. Yeah. And are now saying, well, I can't do that. So do I sell before I die? Or do I look to do something else in the latter years of my life? So again, some big fundamental changes.
And I think the farmers were out protesting, weren't they, on budget day?
Yeah,
you see them with their tractors and their placards. They were I mean, still very angry about it. And I'm looking forward to Jeremy Clarkson's new series where there was a tiny half a second flash, and it was the Chancellor with the red briefcase. It is a big issue for farmers and business owners.
Yeah, and I think at the moment, the farmers are very much aligned in relation to their protests.
Yeah,
I mean, obviously for the other business owners, where business property relief, perhaps less so. So
it's a very fragmented bunch.
Yeah,
someone could be owning a factory, someone could be running a newsagent, someone could be, I don't know, a software business. They're so different. That,
I mean, certainly at the moment there seems to be it's kind of very much we'll treat them both the same. I wouldn't want there to be a stage where perhaps because the farmers have been more vocal in their protests that something happens in relation to agricultural property relief, but not
business. Yeah.
Let's hope that doesn't happen.
The issues are the same, aren't they? The continuity of that business.
Yeah, very
beyond
much.
Death.
Yeah, very much.
So you're going to have to break up your business if the patriarch dies.
Yeah.
Which, hopefully it doesn't lead to job losses, but I can very well see that happening.
Yeah. Doesn't make any sense at all.
I think, you've got some business owners that are, making some quite drastic decisions, some big decisions off the back of that change that they probably weren't doing before.
Yeah.
So it's again, it's a lot of changing decisions going on.
Yeah.
Something I noticed as well is one for the billionaires, I suppose. If you got an offshore trust and you're one of these billionaire non-doms, there's now a £5 million limit every 10 years to your relevant property trust tax charges. I was having a look at it. I did a quick calculation, and it only affects people who've got offshore trusts that are worth more than £83 million, and they were set up before 30th of October 2024. So we've already had a few big name billionaires leave the UK. I don't think this is going to change their minds one way.
Yeah, I don't think so.
I guess if you break it down every 10 years, it's like a wealth tax of $500,000 every year, but the damage is done, I think.
I think so. I think that, as far as people deciding whether or not they wanted to leave the UK, I think, most of them have made that decision.
Yeah.
And, some have stayed, but, we're aware, and lots of other firms that do that kind of work are well aware that those clients that want to have gone.
Yeah. Another one for these offshore trusts is apparently some people were putting their farmland and farm buildings into offshore trusts. They've basically said now that it's going to be treated the same way as residential property, and it's effectively a kind of look-through thing. Mm-hmm. It will affect some clients, but
I think it'll affect some. But again, it's probably I think HMRC or the Treasury like to use it as a we're just clarifying the rules, which means we don't like what's going on, so we're just going to make sure you're aware that we don't like it.
Yeah. I think this is a big one for the Treasury is the pension salary sacrifice. It's a bit fiddly to explain, but essentially, and I guess it normally goes on in companies or firms where you have higher paid employees. instead of getting a pension contribution and making it personally from your post-tax and national insurance, is that a word? Income, your employer will say, all right, well, I'll pay you 20 grand less, but I'll put 20 grand into your pension, and you didn't have to pay national insurance, and nor did the employer.
Yeah.
The government are saying that that's now capped at, well, from April 2029, it's going to be capped at 2,000. And after that, if you make contributions by way of salary sacrifice, there are national insurance contributions to be paid.
Yeah, I think that was quite a big thing for employers trying to find tax
efficient ways to remunerate their employees.
So share options is certainly a thing, but pensions was another thing that was just a more efficient way of incentivizing staff. And that's just something now that they've stopped. The income tax reliefs are still there, which is obviously great, but the national insurance aspects were significant. When you're talking, the levels of employers' national insurance that we have, I think it will change the way businesses approach that kind of thing.
Yeah, people are going to be less attracted to making pension contributions.
Yeah.
So I guess that's affecting maybe the more, I don't know, the higher rate employees, I suppose. Looking at national living wage and minimum wage, both of those are up. We've got I guess this is going to affect hospitality, retail clients especially.
Yeah, those who are
added to the business rates and the national insurance changes we had in the last budget.
Yeah.
I mean, what was interesting, and certainly around the business rates aspect, there was quite a lot mooted around business rates kind of breaks and reliefs. But I think what wasn't mentioned was that some of the previous reliefs were being phased out.
Yeah.
So in essence, I think there was quite a lot in the press over the weekend of people saying, well, actually, my rates are going to be thousands of pounds higher even with this, because of the previous reliefs that are being eroded. So again, not quite a correct message in relation to rates to say, we're going to be doing all these great things to help certain areas of business, but forgetting to mention the fact that the previous help is being removed.
Yeah.
And I saw a very interesting statistic that as a country we have one of the highest minimum wages, which is obviously fantastic, but we have one of the lowest growth rates out of the G7, which suggests that the two things are pulling in opposite directions. And how do we fund having such a healthy minimum wage?
I think that's it. The retail, leisure, those areas, the increase in national insurance and all the other, the things that have been going on in relation to minimum wages and other things. It's really, these businesses work on very narrow margins at the best of times, and this is really difficult for them. Really, difficult.
Combined with your everyday, your average taxpayer taking, having less money to spend because of the fiscal drag.
Yeah,
they've got less money to spend on leisure and hospitality or retail.
Yeah, I think everyone's saying.
So the customers are hit, the employers hit.
Yeah,
and I think those businesses will make decisions off the back of that. They perhaps won't expand like they were going to expand and hire more people.
Yeah,
because they know that they don't want to scale up and take that risk. So it's having a real effect on businesses.
Okay, what about employee ownership trusts? So I think if you sell your business to an employee ownership trust, which I suppose is, I guess the rationale behind it was it's supposed to be altruistic and you're handing over the business to the employees. And you used to get full tax relief on the capital gain. Now it's, what is it? It's 50%.
50%. Yeah. So, I mean, it was something that probably, yes, it was used, but perhaps wasn't used a great deal. Mainly perhaps because business owners, weren't looking for a particular exits, or they perhaps were looking to pass on to family or other things.
Yeah.
But there were quite a few businesses that were saying, well, the people that have helped build my business are the employees. And if there's a way that we can structure this so I can pass it on to the employees that know the business and obviously have a good tax outcome from the back of it, then why don't we do that? So yeah, interesting that it's been cut. I mean, ultimately it's still a good planning opportunity for.
It's still an effective rate of tax of 12%, which
exactly.
It's Better than a slap in the face.
Of course. So, a lot better than, the current rates of capital gains tax. So I think it's not going to stop anything in relation to that kind of work. And in fact, it might actually raise awareness where there wasn't awareness before. So, again, it's no bad thing.
I also, electric cars. I don't know if either of you have electric cars, but if you do, you're paying 3p a mile.
Again, I don't know what you think, Janice, but I don't know quite how they're going to impose this. I'm still trying to get my head around how they're going to...
Is it going to be self-reported? Is the guy who does your MOT going to snitch on you if your mileage isn't what... I just don't know.
Yeah,
or we can have a black box in our car that just tracks us everywhere.
I think there was a comment that you're not going to have a black box in your car, but I still can't work out exactly how it's going to work.
Oh, I think you're right. The only recording of mileage is on your annual MOT certificate. So is it on the back of there? They add it on to the cost of the MOT.
But I think it's interesting that lots of people are moving to electric cars. Again, we've talked about salary sacrifice, but employees getting their car through some sort of salary sacrifice scheme with their employer. So a lot more electric cars now, and obviously, the government's aware that their
getting less from fuel duty.
Their tax take from petrol is either stagnating or going down, and that's a hole that needs to be filled. So unfortunately, whilst you're saving the planet by going to an electric car, it's going to start costing you, and I think it's probably only going to go one way moving forward. But I think it's trying to make it reasonable and affordable, as we're talking about.
And do you think there was a kind of, angry fist at the people who've gone non-resident? I think there was changes to the temporary non-residence rules. So that was post-departure profit dividends. Yeah,
I mean, a big thing. I think, you and I, Janice, have both, come across this in the past with our clients. There's It's quite difficult to explain.
Yeah, it's a tricky one, isn't it? Because it's it's close company, so that's basically a personal company rather than dividends from a big organisation. If you leave the UK and you own a close company, any dividends that you receive, you're going to be taxed if you return within 5 years.
Basically, what it was before was it was only so obviously a company builds up profits, and to the extent that your dividend was matched to profits that were earned before you left the UK, those profits, if you came back to the UK within 5 years, were taxed in the year that you returned. But it was only those pre-departure profits that were paid as a dividend.
Because I guess the trick was, or before temporary non-residence was, all right, let's just build up loads of profits, hop abroad for a year, and hop back.
Yeah,
and the temporary non-residence rules are designed to prevent that mischief.
Yeah, exactly. And I think worked very well. You had to be out for more than 5 years in order to kind of avoid that tax charge in the year of return. Now they've changed the rules to say kind of doesn't matter where the profits arose from that you got the dividends while you were non-resident. If you come back within 5 years,
So this is a trying to catch those people who've moved to Dubai, where there are no taxes on the dividends.
I think,
but I suppose our advice stays the same: stay out for 5 years or more.
Yeah, I think it is. I think practicalities of staying out for 5 years though shouldn't be underestimated. I think lots of people talk about, well, you can do this, but I think actually being out of the UK for 5 years is difficult, particularly if you maybe have business interests here or family here. It's very difficult, or your social connections are here. Yeah. It's very difficult to stay out for 5 years, and you have to be very careful. I think HMRC are definitely going to be looking at the statutory residence test and making sure that people have got correct documentation in relation to that. I think a claim to be non-resident is a claim, and you need to be able to justify it. So I think it's the practicalities of staying out for 5 years or more.
And if you've still got all those ties to the UK, you could be down to 16 days, and it's counted at midnight. And are you working? It's notoriously difficult.
Yeah. Some glimmer of hope, though. They have confirmed that they will allow double tax relief if tax has been paid on those dividends elsewhere. I think that's a positive move, so that that credit is for sure. So I think clients have to review their planning before the 6th of April
Yeah.
26, and make sure that, they understand what the implications are.
I also saw another angry, gesture towards the people who've gone non-resident. It's now more difficult to pay voluntary national insurance because it was a cheap way to get access to the UK state pension. That's been tightened up. I don't know if you saw that in the...
Yeah, I think again, it's you're trying to, in some ways, curtail the pension bill, the state pension bill, and where again they've seen a loophole that people have been taking advantage of, and just decided, well, that's just a very easy fix, and no one's really going to kick up a fuss about it.
There was also something about, and I know both of you deal with a lot of showbiz talent and sports, media, entertainment. Something about image rights was in the document.
Yeah, it's very common for people, particularly in sport, to be paid for their by the club for their playing activities, but also for an element of the use of their image rights.
Mm-hmm.
And typically that has been previously structured not as employment income, and usually via an image rights company.
Yeah.
Again, another clarification, I think, was it Steve, to say that they are clarifying the rules that now image rights payments paid in conjunction with your employment to be treated as employment income, with effect from the 6th of April 2027. So I'm sure that will cause a lot of renegotiations. And obviously additional costs, not only for the individual, but for the club as well.
I think that is fairly, as far as that, say, industry, to call it, to perhaps maybe a bit of an exaggeration, but it's pretty seismic, I would say.
Yeah.
That there's long been a friction between the sports people, clubs, and HMRC in relation to image rights and how they're structured and paid and what they really are. So again, as we said, it was interesting for HMRC to come out and say that we're going to clarify the rules in relation to that. And I think again, it's just an example of HMRC saying perhaps we've not been able to get the success through the courts that we perhaps wanted. So we're going to change that. We're going to change the rules to make sure that we can get the chunk of money that we think we should get.
Yeah.
What else is there? Something I wrote a note down. There was something about EMI as well. I guess basically they're making it easier to access the. Yeah,
again, I think that was perhaps one of the brighter points in perhaps an otherwise fairly pessimistic budget.
Yeah, it was a stormy day, and this was the one glimmer of sunlight.
I think there was obviously increasing of the allowances for VCTs and EIS, which is, as we know, a kind of a vital tax advantage for new startup businesses. I think it's interesting just to obviously mention that the VCT rate of relief is decreasing from 30 to 20%.
Oh yeah.
So whilst perhaps the limits have gone up, there is a reduction in the relief for VCTs. But obviously EIS we know is important. But then again, off the back of that, we talked about salary sacrifice again being something that businesses use to kind of give tax incentives or incentives to their employees. EMI again, share options are particularly relevant in relation to incentivizing staff, particularly for startup companies who perhaps don't have the cash to give bonuses. EMIs are very good from a tax perspective, and they've very much increased the limits in relation to those EMI schemes, allowing it for much larger companies, up to 500 employees, allowing the holding period for these options to increase up to 15 years. So again, that's they're things that I think we've seen a lot of businesses start to explore, because obviously, yes, there's obviously a cost, but compared to physical cash, when you don't have physical cash, and it's it's a great way to incentivize those employees, particularly key employees who you think are going to help grow your business, to keep them engaged in the business, to drive them in relation to getting the best deal that you can for your company. So I think those share options in EMI particularly are are going to be very relevant moving forward.
Okay,
And they
some
already
good
are.
news finally.
Yeah, it is some good news. There is some good news there, but I think, there's definitely something businesses should be exploring, particularly those new, scale-up businesses.
So I guess where we land is we've got 26 billion of tax rises. 8 billion of that's coming from the big freeze that I'm calling it. I decided this morning I'm calling it the big freeze. The pension salary sacrifice is going to be 4.7 billion. The dividend, property and saving tax rise is going to be 2.2 billion. And then there's lots of just little bits for everything else to get us up to the 26 billion. So
yeah,
and a lot of it doesn't take effect immediately.
Yeah, it just seemed to be quite a lot of the government don't seem to like people saving money, do they? I mean, there's a attack on interest.
There was something about ISAs as well.
Yeah,
they don't want you putting into your cash ISA.
Exactly, cash ISAs. No,
if you're under 65 or something.
Yeah, I mean, it seems that it's and again we've touched on it already. People changing the way that they approach things. It's whether it's just trying to get the cash into the economy, stop people. And I don't think anyone's hoarding cash, but it seems to be that's they're wanting to get that money out there and moving.
Okay, well, I suppose we'll wrap it up soon, but I don't know. I like to have a little quote. So in the 1600s, Louis XIV's Minister of State Jean-Baptiste Colbert is reported to have said, "The art of taxation consists in so plucking the goose as to obtain the largest possible amount of feathers with the smallest amount of hissing." Do you think the UK's goose is hissing right now? What do you reckon? Is that goose hissing?
Yes, I think it's hissing, and I think it will hiss more as these different measures come in over the next few years. But I think the government are hoping we'll have forgotten about them and we won't hiss as much as they come in.
As they come into the next election cycle.
Yeah.
What do you think, Steve?
I mean, I would agree. I think we're kind of reached the limit of what perhaps the taxpayers willing to accept. And I've really struggled to find where there's places that we can get additional taxes moving forward. I do wonder whether we're going to have a few years of pain, and there may be some perhaps relaxation of some of the rules when we're getting when the budgets elections in sight. But we'll have to see. But it's going to be a couple of years of pain before we get.
A years of hissing, is it?
I think there's definitely going to be a couple of years of hissing. Yeah, you're quite right.
All right. Well, anything else you want to talk about before we wrap up?
No.
Well, thank you very much for sharing your thoughts and wisdom. Pleasure as always.
Yeah, pleasure's mine. Thank you very much.
I'll see you back in the office.
Yeah, let's get cracking.
Thank you.